You've heard the number 100 times before you ever see the spreadsheet. $500 million in real estate, 34 properties, 6,000 doors. People say it the way they'd say a magic word, slow, with a little air behind it, and then they stop talking because the number is supposed to finish the sentence for them. Then you get the login. It's 6:40 in the morning on the 11th floor of a building the family doesn't own because the family office rents and you're the second person in. The lights come up on motion. There's a $9,000 espresso machine in the kitchen that 4 people know how to use and a conference room named after a lake in Michigan. Your badge works on 2 doors. One of them is the room where the bank statements live. Your name is Ren Castellanos. You're 29, you make $118,000 a year plus a bonus that depends on things you don't control, and your job title is asset management analyst, which in practice means you are the person who reconciles what the buildings actually did against what everyone said they would do. You don't own anything, you don't sign anything, but you see every number before the man whose name is on the door does, because you're the one who assembles the page he reads. His name is Desmond Vale. He's 67. He drives a 2019 Tahoe with 141,000 miles on it, and he asks you the same question every single Monday, and it is never what's the portfolio worth. It's what's coverage. You didn't understand that question for the first 4 months. Now it's the only one you'd ask. Here's what you learn when you get the login. $500 million is not money. It's an appraisal. It's the estimated value of 34 buildings if you sold all of them into a normal market to buyers using normal debt on a normal Tuesday. And none of those 3 things is ever true at the same time. There is no vault, there is no account with a 5 and 8 zeros in it. When you open the actual operating accounts on the first business day of the month across every entity, every property LLC, every reserve, the cash on hand is about $12.1 million and roughly $9.3 million of that is already promised. Tax escrows, insurance escrows, lender-required replacement reserves, a construction draw in Tampa, 2 security deposit accounts you're not legally allowed to touch. $500 million in real estate. Under $3 million that anybody can actually decide something with. So the number people gasp at is not the number that runs the empire. The number that runs the empire is what the buildings collect, and then what's left of it after each layer takes its cut. And there are more layers than anyone outside the room believes. You build that page every month. It starts at the top with the biggest, prettiest, most useless number in the whole business, gross potential rent. Gross potential rent is what the portfolio would collect if every single unit were occupied at the rent you're asking today for all 12 months and every tenant paid in full and on time. It's a fantasy, and it is deliberately a fantasy. It's the ceiling so you can measure the distance you're falling from it. On this portfolio, gross potential rent is $50.6 million a year. Then you start subtracting, and the subtracting never stops. Vacancy first. The portfolio runs about 94.5% physically occupied, which is a genuinely good number, and it still costs you $2.78 million a year in rent that simply does not exist. Then concessions, the 6 weeks free you gave away on 190 units in Phoenix in February because your competition 3 blocks over was giving away 8. That's $610,000 you agreed to not collect. And it never shows up in the headline rent, which is exactly why owners love concessions and lenders hate them. Then bad debt. People lose jobs. People skip. Eviction takes months and costs money, and at the end of it, you own a unit that needs $4,200 of work. Call it $415,000 you invoiced and will never see. And then the part nobody tells you about, loss to lease. Your in-place leases are older than your asking rents, so the rent you're advertising and the rent you're actually banking are 2 different numbers, and the gap on this portfolio is another $840,000 a year. Then finally, something goes back the other way. Other income. Parking at $75 a space, pet rent at $35, valet trash at $28, utility billbacks, application fees, the laundry rooms, the storage cages in the Columbus Industrial Park. It's unglamorous and it's real. $2.24 million a year. Do the arithmetic and you land on effective gross income. $48.2 million. That's the empire's actual top line, not $50.6 million. And notice what just happened before you have paid $1 single to a plumber, a tax collector, an insurance carrier, or a bank before anyone has done anything. Roughly $4.6 million of the rent roll has already evaporated into vacancy, concessions, deadbeats, and old leases. 9% gone, and that's in a good year with good occupancy. Then the operating expenses come out. Everything it costs to keep 34 buildings standing, staffed, insured, taxed, leased, and legal. On this portfolio, it's $21.2 million. What's left is $27 million. $27 million of net operating income on a $500 million portfolio. That's it. That's the real number. That's the paycheck the entire empire generates in a year, and if you're doing the math in your head, yes, it's 5.4% of the headline value, and no, that is not a coincidence, and we'll get to why. But here's the thing you have to sit with, because it took you 4 months to sit with it. $27 million is not what Desmond Vail makes. It's not even close. That $27 million walks out the door in front of you, most of it, before it ever gets near him, and the biggest piece of it goes to people who never once set foot in any of these buildings. Follow the $27 million. That's the whole story. But before you follow it out the door, go back up one line to the $21.2 million that never becomes net operating income at all. That's the part people assume is boring, and it's the part that quietly decides whether any of this works. The single biggest line is not the plumber, it's the county. Property taxes across 34 assets in 5 states come to $7.9 million a year, and you have no negotiating leverage over them except a consultant in Tampa who costs $60,000 a year in appeals assessments and who earns his fee about 2 years out of 3. Taxes go up when values go up, which means the appraisal that makes Desmond richer on paper also raises his bill in cash. You've watched him get a $2.1 million valuation increase on a Phoenix asset and immediately ask you what it did to the tax escrow. That's the reflex of somebody who's been doing this for 40 years. Insurance is $3.4 million. 4 years ago, the same coverage on nearly the same portfolio was $1.9 million. Nothing about the buildings changed. Carriers repriced coastal and hail exposure, deductibles moved from flat dollars to a percentage of insured value, and one Tampa property now carries a named storm deductible of 3%, which on a $71 million replacement cost means the first $2.1 million of hurricane damage is yours. That's not insurance. That's a coupon. Then site payroll, $4.1 million, property managers, leasing agents, maintenance techs, the guy in Columbus with the forklift certification. Repairs and maintenance, $2.6 million, which includes turnover. Every move-out costs you paint, carpet or LVP, a cleaning, a locksmith, and 11 days of vacancy, and at roughly 45% annual turnover across 6,180 units, you are doing that math about 2,800 times a year. Utilities you can't bill back, $1.75 million. And the property management fee, 3% of collections, $1.45 million a year, paid to a third-party operator on 22 of the assets because Desmond decided in 2016 that owning a management company was a different business with different lawsuits. Added up, $21.2 million against $48.2 million of effective gross income. An operating expense ratio of about 44%. That number is the whole game and nobody outside the industry knows it exists. Newer Class A product typically runs somewhere in the 35% to 50% range. Nice systems, warranties, efficient envelopes, higher rents to divide into fixed costs. Older, smaller, workforce-grade stuff runs 50% to 65%, sometimes worse. Same rent roll, wildly different survival. Your 1974 Phoenix asset runs 57% OPEX. Your 2021 Tampa build runs 38%. On paper, they're both multifamily. Operationally, they are different species, and the difference shows up entirely in the NOI margin, because NOI margin is just that expense ratio flipped upside down. And notice what is not in the $21.2 million. Capital expenditures aren't in there. Roofs, parking lots, HVAC replacements, boilers, elevator modernizations, those sit below the NOI line funded out of reserves. This portfolio budgets $300 per unit per year for replacement reserves, about $1.85 million, and every serious person in this room knows $300 a door is a polite fiction on a portfolio whose average build year is 1998. Keep that in your pocket. It comes back. So $27 million of NOI. Now the bank. Total debt across all 34 assets is $312 million. Against a $500 million valuation, that's about 62% loan to value, and if that sounds conservative to you, it's because you learned about real estate leverage during a different decade. The old commercial norm was 75%. In 2026, the range that actually gets quoted is 60% to 75%, and a lot of banks and life companies are capping around 60% to 65%, unless the sponsor is exceptional and the asset is boring in the best way. Lower leverage also buys you a better rate. That relationship is direct, not decorative. The same lender who'll do 70% at high sevens will do 60% at low sixes on the same building, because they're pricing their own downside, not your ambition. Blended, this portfolio pays about 5.9% on that $312 million, and total annual debt service, principal and interest is $21.4 million. Look at those two numbers next to each other. 27 million of NOI, 21.4 million to the lenders. 79% of everything 34 buildings earn, after every expense, goes to institutions that will never smell a leasing office. The ratio between them has a name, and it's the question Desmond asks every Monday. Debt service coverage ratio. NOI divided by debt service. 27 over 21.4 is 1.26 times. Lenders don't ask how big your portfolio is. They ask for coverage. Stabilized multifamily typically needs roughly 1.20 times to 1.25 times. Something lenders consider volatile, hotels, self-storage, anything with daily or monthly pricing, often needs 1.40 times, 1.50 times, more. The Charlotte office building is quoted at 1.35 times now, because office cap rates and office tenancy have both been on fire in the wrong way. Here's the part that reframes everything. Coverage doesn't just measure your debt. It caps it. At today's quotes, call it 6.75% on a 30-year amortization. Every dollar of NOI supports about $10.25 of loan at 1.25 times coverage. Run that on $27 million. And the portfolio's borrowing capacity today is roughly $277 million. Desmond owes $312 million. The debt on this empire would not be approved on this empire. It exists because it was written in a cheaper world, and the only thing holding it up is the interest rate stamped on paper signed years ago. Which brings you to the thing that keeps you at your desk past 7. Start with the $41 million of that $312 million that isn't fixed at all. It's a bridge loan on the Phoenix Value Add, priced at a floating index plus 285 basis points, and every 100 basis points of movement on it costs $410,000 a year straight out of coverage. Desmond bought a rate cap to fence that in. It cost $1.4 million up front. It expires in 9 months, and the renewal quote on your desk right now is $3.1 million, $1 million insurance policy that now costs $3 million on debt you didn't want floating in the first place. That is what interest rate exposure actually looks like from the inside. Not a headline, an invoice. And then debt has maturity dates. 3 loans, $86 million combined, all interest only at 4.35%, all coming due in 14 months. Those 3 assets throw off $5.9 million of NOI, so today they cover their $3.7 million of interest at a fat, comfortable 1.58 times. Now reprice them. Commercial mortgages in 2026 quote roughly high 5s to high 8s depending on asset, sponsor, and leverage. Call it 6.8% with amortization. Debt service on the same $86 million goes to about $6.7 million. Coverage on those 3 buildings, 0.88 times. They don't cover, not close. So the lender won't lend $86 million against them. The lender will size the new loan to 1.25 times coverage, which is about $60 million. Meaning 14 months from now, to keep 3 buildings he already owns, Desmond has to bring roughly $26 million in cash to a closing table. The portfolio's entire free cash flow after debt service is $5.6 million a year. You've run that spreadsheet 11 times looking for the arithmetic error. There isn't one, which raises the question you should have asked on day 1. Where does the $500 million come from? You've now traced every dollar these buildings collect, and nothing in it added up to $500 million of anything. It came from one division problem. Net operating income divided by cap rate equals value. That's it. That's the entire valuation apparatus of commercial real estate. One line of 8th grade arithmetic, and every appraisal, every broker's opinion of value, every lender's underwriting model, every number Desmond Vail sees on a personal financial statement is downstream of it. 27 million of NOI. A blended cap rate of 5.4%. $500 million. A cap rate is just the yield a buyer demands for owning that income stream unlevered. Low cap rate means buyers are hungry and confident and will pay a lot for a dollar of rent. High cap rate means they want to be paid more to take the risk, so a dollar of rent is worth less. In 2026, the ranges are specific and they are not the same everywhere. Multifamily in primary markets trades roughly 4.5% to 5.5%, with the average across all classes sitting nearer 5.6% once you fold in older product and secondary markets. Industrial runs roughly 5% to 7%. Office is wide open and ugly, roughly 7.6% to 9.4%, depending on class, tenancy, and whether anyone believes the rent roll survives renewal. Which is why your portfolio's 5.4% is a blend, not a fact. The 2021 Tampa build appraises at a 4.8%, the 1974 Phoenix asset, 5.6%, the Columbus Industrial Park, 6.2%, and the Charlotte office building sits at an 8.7% cap, which is the market politely telling you it does not want your office building. Now here's what you understood in month 5, and it changed how you look at rich people permanently. Nobody knows what any of this is worth. You've read the appraisals. An appraiser establishes a cap rate by looking at what comparable buildings recently sold for. 3 comps, 4 if you're lucky, adjusted for age and location and unit mix by a human being applying judgment. One of the comps on your Phoenix appraisal was a seller with a maturing loan and no refinancing options, which is a polite way of saying somebody sold under duress and their bad Tuesday is now a data point in your net worth. The $500 million is not a measurement. It's an opinion formed from a handful of other people's negotiations and updated whenever those people transact. Watch what that means mechanically. Hold the rent roll perfectly still. Not $1 of rent changes, not one tenant moves, not one expense moves. Now let cap rates expand by 100 basis points from 5.4% to 6.4%, which is a smaller move than the market has made twice in the last 4 years. The same $27 million of NOI now divides into $422 million of value, $78 million of net worth deleted by nothing. And because there's $312 million of debt sitting underneath it, the damage lands entirely on the equity. Desmond's equity in this portfolio at a 5.4% cap is about $188 million. At a 6.4% cap, it's $110 million. He lost 41% of his net worth while every one of his 6,180 tenants paid rent on time. It runs the other direction too, which is why nobody in this business ever admits it out loud. Compress cap rates half a point to 4.9%, and the portfolio is suddenly worth $551 million, and his equity is $239 million, and he is $51 million richer for having done absolutely nothing on a Thursday. Everybody with a portfolio between 2012 and 2021 got told they were a genius. Most of them were a beneficiary. Leverage doesn't just multiply your returns. It multiplies the cap rate's opinion of you. Then there's the other half of this, the half that makes real estate different from every other asset a person can own. Because while all of that value is moving around, the IRS is looking at a completely different set of books. Buildings wear out, so the tax code lets you deduct a portion of the building's cost every year as depreciation, on a straight line, over 27.5 years for residential rental property and 39 years for commercial. Not the land doesn't wear out, just the improvements. Across this portfolio, cost basis in improvements is about $330 million, and the annual depreciation deduction that throws off is roughly $11.4 million. Now do the tax math on an empire that just banked $27 million of NOI. Subtract the interest portion of debt service, about $18.1 million. Subtract entity-level overhead, legal, audit, and asset management, about $1.4 million. Subtract $11.4 million of depreciation. The portfolio reports a taxable loss of roughly $3.9 million. It banked $48 million of income. It generated $5.6 million of cash after paying every lender. And on the return, it lost money. That's not a loophole anybody snuck through. It's the deliberate design of the code, and it's the reason a real estate owner and a surgeon making a fraction of his cash flow can have wildly different tax bills. Depreciation is a deduction you take without spending a dollar. Then the sharper version. A cost segregation study sends engineers through a building to reclassify components out of the 27.5 or 39-year bucket into 5, 7, and 15-year buckets. Appliances, cabinetry, flooring, specialty wiring, land improvements like parking lots, sidewalks, and landscaping. Same building, same total deduction, front-loaded. On the Tampa asset, a $47,000 study moved $14.9 million of basis into short-life categories, and paired with bonus depreciation, the first-year write-off went from about $2.5 million to nearly $17 million, which is wonderful, and which is a bill, not a gift. Because every dollar of depreciation you take reduces your basis, and when you sell, the gain attributable to all that depreciation gets clawed back. Unrecaptured Section 1250 gain is taxed at up to 25% federal, not your long-term capital gains rate, a higher one, and the components you accelerated into 5 and 7-year life come back as Section 1245 recapture at ordinary income rates. Accelerating depreciation doesn't shrink the bill. It enlarges the recapture and moves the pain later. On the Phoenix asset alone, 11 years of ownership, $9.4 million of depreciation taken. Sell it and roughly $2.35 million of federal tax comes due on the recapture before you've discussed the appreciation, the capital gains, the 3.8% net investment income tax, or the state. So Desmond doesn't sell it, he does a 1031 exchange. Sell the building, and instead of touching the money, a qualified intermediary holds the proceeds while you identify a like-kind replacement within 45 days and close within 180. Do it right and the entire gain, recapture included, rolls into the new property and the tax bill is deferred. Not reduced. Deferred indefinitely, potentially forever, because you can keep doing it. You've watched him do it 3 times, and you've noticed that the deferred tax never disappears from your files. It just gets carried forward, quietly compounding, into a building with a low basis and a bigger number on the door. Which leaves the last thing, and it's the thing you'd never have thought to wonder about before you had the login. If the buildings only generate $5.6 million of free cash and most of that gets eaten by reserves and overhead, and if selling triggers a tax bill nobody wants, where does a man with $500 million in real estate actually get money? There are exactly 2 taps. He sells or he borrows against himself. The second one is the whole trick, and it's why serious owners refinance rather than sell. A cash-out refinance is not income, it's a loan. You put a bigger mortgage on a building you already own, you pocket the difference, and because borrowed money isn't a sale, there's no capital gain, no depreciation recapture, no Section 1250, nothing. You keep the building, you keep collecting the rent. You keep the depreciation deduction, you keep all future appreciation. And you walk away from the closing with cash the IRS does not consider to have happened. You ran that on the Columbus Industrial Park in March. Bought in 2015, worth about $58 million today at a 6.2% cap on $3.6 million of NOI, and the existing loan had amortized down to $24 million. New lender, 6.9%, 25-year amortization, size to a 1.25 times coverage minimum, which lands the loan at $34.4 million, call it 59% LTV, so it clears the leverage test too. Wire out, net of costs, $9.7 million, tax-free, in Desmond's hands. And here's the price of it, which nobody puts in the celebratory email. Coverage on that building went from 1.79 times to 1.25 times. You didn't create $9.7 million. You converted a safety margin into cash. That building has no cushion left, and it used to be the one you never worried about. Now the part that surprised you most, because you assume the owner keeps what the empire earns. 19 of the 34 assets have outside investors, and on those 19, most of that equity isn't his. The equity sitting above the debt on the joint venture assets is about $118 million, and $94 million of it belongs to limited partners, dentists, a Midwestern family foundation, 2 funds of funds, and 11 people who came in through one guy in Scottsdale. Desmond is the general partner. His own co-investment is $24 million. And the LPs get paid first. That's what a distribution waterfall is. Step 1. Limited partners receive a preferred return, commonly 8%, and it's 8% here before the sponsor sees a nickel of profit. Step 2. They get their capital back. Only then does Step 3 happen. Profits split, typically 70-30 or 80-20 in the LP's favor, and on this portfolio the split shifts further toward the sponsor above a 15% IRR hurdle on refinance or sale proceeds. That upside slice is called the promote, and the promote, not the management fee, is where a general partner actually gets rich. Except run the arithmetic on this year. An 8% preferred return on $94 million of LP capital is $7.5 million a year. Those 19 buildings produce $15.8 million of NOI, hand $12.5 million of it to lenders, and after replacement reserves and entity overhead leave about $2 million actually available to distribute. The pref doesn't stop accruing because the cash stopped. It compounds, in a column in your workbook, and right now that column says the sponsor is roughly $5.5 million further behind his investors than he was in January. Every dollar of that has to be cleared before a single dollar of promote exists. So the $9.7 million from Columbus? Almost all of it goes to LPs. Desmond's promote on this portfolio today is a theoretical number that requires cap rates to cooperate. So what does the man actually live on? The management company collects an asset management fee of 1.25% of effective gross income, about $600,000, and that fee doesn't even cover the family office it's supposed to fund. 7 salaries including yours, the rent on the 11th floor, Yardi, Argus, CoStar, the audit, the tax preparer who charges $190,000 because there are 41 entities. The real money comes from the 15 assets he owns outright with no partners and no waterfall. Those produce $11.2 million of NOI, pay $8.9 million of debt service, fund $600,000 of reserves, and distribute the rest. Last year, total cash distributed to Desmond Vail personally, $1.68 million. Call it $140,000 a month, pre-tax against a headline of $500 million. Roughly a third of 1% of the number people gasp at. And a meaningful chunk of that gets held back because he keeps about $4 million personally liquid at all times. Not to be prudent, but because he has a $26 million closing coming in 14 months and a rate cap renewal quoted at $3.1 million. That's why he drives a 2019 Tahoe, not stealth wealth. Arithmetic. And this is where you learn what actually kills portfolios this size, because it is never a bad year of rent. 61% of the NOI comes from 2 submarkets, one in Phoenix, one in Tampa, both of which absorbed more new supply in 3 years than in the prior 12, which is why you're handing out 6 weeks free. That's concentration risk, the same bet, 34 times. Then the CapEx surprise, the roof consultant priced 14 Phoenix buildings at $4.6 million against the entire portfolio's annual replacement reserve of $1.85 million, and that was before a riser let go at 2 a.m. in September and put 9 units out of service for 5 weeks. And underneath all of it, coverage. Slip below the covenant and the lender doesn't call. It just flips a switch, a cash management agreement, a lockbox. Every dollar of rent sweeping into the lender's account until coverage is restored, which means the owner of a $500 million portfolio loses the right to decide what his own buildings do with their money. The last stop is a forced sale, and forced sales don't happen at 5.4% caps. They happen at whatever a buyer with cash feels like offering to somebody with a maturity date. So it's 6:40 on a Monday and you're the second person in, and at 7:15 Desmond Vail comes down the hall in a fleece vest and stops at your desk and asks you the only question he ever asks. You say 1.26. He nods and he keeps walking, and you sit there with a portfolio worth $500 million on a page and under $3 million anybody in this building is actually free to spend. And you finally understand that the number on the outside and the number on the inside have almost nothing to do with each other. The expensive mistake in this whole video is a single confusion, treating equity like it's cash. It doesn't cost you a percentage point. It costs you your maturity date, and you don't find out on the day you're wrong. You find out 14 months later at a closing table where the lender wants $26 million you don't have. At 3 properties instead of 34, the number is smaller and the ending is the same. I wrote the book because nobody explains the coverage math until it's already too late to fix. Links in the description.